Hi, good afternoon, everybody. Absolutely delighted to be here to talk to you about the Baillie Gifford Managed Fund. Looks like you've got a great schedule ahead of you later on today also. Now, a key part of my role as a specialist on the Baillie Gifford Managed Fund is talking to investors. That includes investors such as you, but also intermediaries and financial institutions. And what I found really interesting over the past couple of months is that despite all of these audiences being very different, the queries and the concerns from each of those parties have been very similar. And it really boils down to three key points: complexity, uncertainty, and trust. Now, I'm not saying that we have all the answers to these questions, but what I'd like to do is address these points in addition to telling you a little bit more about the Baillie Gifford Managed Fund. Clearly, these are issues that have been around for a number of years, but they are bigger problems at this point in time. Now, I'm sure many of you will be familiar with Baillie Gifford and our managed fund, but for those of you that aren't, Baillie Gifford was founded over a century ago, and we've been running our managed fund now for more than 3 decades. Over that time, the fund has delivered a return of 9.2% per annum, net of all fees and expenses. Now, the secret to the fund's success is simple, but it's an approach that isn't necessarily easy to enact. And a large part of that is because of how complicated the financial services industry has become. Now, I'm going to tell you something that you don't often hear at other events, and that is that investing is difficult. It's not easy. We are still learning. But we believe very strongly that you don't need complexity for success. And in actual fact, sometimes the simplest solutions can be the most effective. And the Baillie Gifford Managed Fund is a fantastic example of that. So what does the fund look like? Well, it's invested in equities, bonds, and balanced with an allocation to cash. We're looking to invest in growing, innovative businesses that can grow clients' capital over the long term. We've got a really experienced team putting this into practice, with investors that have over 20 years investment experience, including several who've spent their entire careers at Baillie Gifford. And they're picking companies from Amazon in the UK, US even, sorry, to Alibaba in China and Spotify in Sweden. And they're bringing them together to form the managed fund. Now, because we've typically got 75% in equities, that's reflecting the fact that we're trying to grow clients' capital over the long term. But being a balanced approach, we believe that it's important to have a meaningful allocation, typically 25%, to the diversifying asset classes of bonds and cash. And the result is a really popular fund that, through good inflows and strong performance, now has £4.2 billion of assets under management. Now, I touched on performance briefly, and I don't want to dwell too long on this page, but if I could draw your attention to the 10-year return figure, it's clear that 10.4% per annum over the past decade, net of fees and expenses, is a good return, and that shows that what we do works. But really central to the success of the Baillie Gifford Managed Fund is Baillie Gifford as a firm. We were founded in 1908 in Edinburgh as an investment management partnership. And I very deliberately say investment management partnership because that structure is so crucial to everything that we do. It provides stability, it affords continuity, and it means that we can be focused on the long term. And why is that important for you? Well, it's important because it means that our interests are aligned, because you too are looking to grow your savings over the long term. It also means that when we are investing, we're doing so with the mindset of an owner, not a speculator. And that's really important when it comes to matters of governance and sustainability, because to be frank with you, if we're investing in companies that are run out with changing societal expectations, they won't be around in 10 years' time, let alone delivering good returns for your portfolio. Now, we may be a century old, but we're still learning, as I said earlier. And one of the things that we've been working on recently is a new way to articulate our investment beliefs. And what it comes down to is actual investing. And no, that's not a typo, it does say actual rather than active. And that's a really important distinction to make because the two things are not necessarily the same. And in actual fact, our industry's failure to focus on actual investing lets clients down. And it's time for those managers that are trying to do a good job to explain why actual investing is so important. Because to be frank with you, the fund management industry is lost. Now, I hate this picture, but it was unfortunately what was sent to me when I asked colleagues to send me a picture of some fund managers. But the industry doesn't help itself. There is a focus on abstract concepts and complexity. Success for many is to marginally outsmart everybody else. And there's an unwillingness to actually think differently. It's better to fail conventionally than it is to succeed unconventionally. And you're now adding into this mix a data arms race for faster, better, smarter information when, to our minds, all that results in is information overload. We think there's a better way, and that's actual investing. So what does that look like? Well, fundamentally, it's about putting our clients' interests ahead of our own short-term profitability. Because actual investors see clients' aspirations, not assets under management. And that's a really important role that we play in the progress of society, because we want to be allocating capital to innovative, growing businesses. That is, after all, what financial markets were set up to do originally. Because actual investors shape the new world rather than shoring up the old one. But you've got to be able to ignore the short-term noise. You've got to be willing to be different, to embrace uncertainty. And that is why Baillie Gifford's partnership structure, away from the noise up in Edinburgh, is so important, because we can invest without being beholden to short-term shareholder demands. So let me give you an example to put this all into practice. This is Cochlear. It's an Australian-listed business that manufactures hearing implants for the profoundly deaf, and it's been held in the managed fund for nearly a decade. Now, as you may guess from the picture, one of its largest markets is in hearing implants for children with disabling hearing loss. And the products are absolutely remarkable in terms of the impact that they have on a child's life, on their ability to learn, their ability to communicate, and their ability to thrive. And there are some fantastic videos on their website that really show the impact that these products can have on a child's development. Now, over the time that we've held this company, it's grown its revenues, it's grown its earnings, it's the market leader, and it's looking to sustain that position by investing heavily in research and development. And from that snapshot of information that I've given you, I'm sure that you would guess that it's been a good investment over the past decade, and you'd be right to assume that. That's the line that we want to see on a share price chart. But what's interesting is if we look at what the market has seen over the past decade, because it's quite different. Buy, hold, sell, beat, miss, a relentless focus on the next quarter. What's going to happen in the next 3 months to this business? And what this all adds up to is over 4,000 alerts on Bloomberg and over 500 analyst target price changes. The noise is simply overwhelming. How can you find the signal amongst this? And if we've not been focused on this, then what have we been doing? Well, we've been trying to understand what's actually going on at this business. We've met management 17 times over the past decade. But above and beyond that, we've been looking to the future, to what this business is really going to look like in a decade's time. We've spoken to users, engaged with members of the deaf community and surgeons. We've met with competition, both listed and unlisted, all to build a better picture of what this company will look like over the next 10 years and beyond. And that's really important, and it really re-emphasizes the significance of actual investing, because in order to generate great long-term returns, you have to be focused on the next decade, not the next quarter. Now, you may be asking yourself, well, that's all very well, but does this add value for my hard-earned retirement portfolio? And that would be a great question to ask. Now, there have been lots of academic studies into the active fund management industry, and this is just one of them, but it is one of the more famous examples. And what it is looking at is the returns generated by US equity mutual funds after all fees and expenses. So I have a question for you first. You'll be pleased to know. Do you think that after all fees and expenses, the average equity fund in the USA generated a positive or a negative return for its investors?
What period?
There's a 1990 to 2003. I can hear a couple of negatives, a couple of positives, so it sounds quite well split. You may be surprised to see the result for those of you who said positive. Return there of minus 0.4% per annum. That is an indictment of the fund management industry. It's not good enough. But when you are looking for a fund for your retirement portfolio, you're looking to pick the best, not the industry. And whilst there are various things to consider depending on your circumstances and your requirements, there are a couple of good things that you can look out for in that endeavour. Because what this study then went on to look at was the impact of active share. So how different a fund is versus its benchmark. So of the marketplace, the 20% most active versus their benchmark, well, the return is really quite different from the study, plus 1.1% per annum after all fees and expenses. And intuitively, that makes sense, because you have to be different in order to outperform. If you look like the benchmark, your fund's going to perform in line with the benchmark, and in actual fact, it will underperform once you've taken all those fees and costs into account. So that's the first thing that you can look out for. But being active alone isn't sufficient, and that was shown in a subsequent study, which further segmented that active portion of the market to look at the impact of turnover, so those funds that are changing their holdings the most and the least frequently. So of the 20% most active part of the market with the highest levels of turnover, well, the results are really quite something. Minus 1.9% per annum after fees and expenses. Those funds that traded more regardless of how actively managed they were systematically underperformed. So what then are the final 20% most active with the lowest levels of turnover? Well, the results speak for themselves. These are the investors that stick with their courage of conviction and remain patient. These are the actual investors. And what this shows is that by picking a fund with a high level of active share and a low level of turnover, it stands you the best chance of identifying a fund that can deliver good returns once all fees and costs are taken into account. It's not a guarantee for success. Unfortunately, there are no guarantees for success. But what it shows is that there are some things that you can look for and that can help you as you try to find a fund for your retirement portfolio. So how does the managed fund stack up against this? Well, high active share, low portfolio turnover. But there is a third key element that you need to look for, and that is, of course, the all-important costs. This is the UK peer group for the Baillie Gifford Managed Fund, set out by ongoing charge. And you can see the sector median fee there, the purple arrow, of 1.04%. Down on the bottom left-hand side, you've got passive tracker funds, cheap as they should be. And then getting on towards an ongoing charge of 2.5%, well, we'll call them the complexity crowd. So where does the managed fund sit? 0.42%. We believe that offering a good value fee is the right thing to do. You should always be asking your fund manager what the ongoing charge is for a fund and whether that represents all of the costs associated with it. It comes back to that point of trust that I was talking about at the beginning. Transparency is really important. And when it comes to costs, even more so, because high costs eat into your returns over the long term. They compound. Keeping them low is great for long-term returns when you have to take into account those costs, and you need to look at the net of fee returns that you are receiving. And that is what the Baillie Gifford Managed Fund has done since 1987. It has delivered those great returns. Now, I gave you some percentages earlier. I always like to put these things into pounds and pence because that's what you're looking at when you go onto your AJ Bell website to have a look at your retirement portfolio and how much it's now worth. And what's really interesting is if you'd had the foresight on the 1st of April 1987 to invest £10,000 in the average managed fund, that would now be worth £94,500, which is a great return over the past 30 years. But I'm not here to talk to you about the average managed fund. I'm here to talk to you about one of the best, because that same £10,000 invested in our managed fund would now be worth over £180,000. And what's really interesting is if instead of charging an ongoing charge of 0.42%, we charge the sector median fee of 1.04%, that £180,000 would now be worth £150,000. Now, that's still a great return over the past 3 decades, but that's the equivalent of 3 times your original investment that's gone to others, such as the complexity crowd. Now, I like this slide because it shows that the performance of the fund has been good, as I'm sure you'll imagine. But it's also a useful point for reflection because there have been numerous crises and crashes over the past 3 decades. And the managed fund has weathered those, and it's weathered those by applying a very consistent investment philosophy and process. And that's what we were talking about in the previous presentation. It's about that consistency of process despite what's going on in the broader world. I also like it because it serves to reiterate why we will never claim to be market timers, because we launched the fund 6 months before Black Monday. So to return to those 3 points I mentioned at the beginning: complexity, uncertainty, trust. I'm not saying that we have all the answers, but I hope that I've given you some food for thought. The managed fund is a simple proposition. It's weathered investment storms over the past 3 decades, and through an unyielding focus on actual investing, has delivered great long-term returns net of fees. We believe that the characteristics of this one-stop shop, its simplicity, the optimism with which we invest, plus its good value fees, leave it well placed to deliver great returns over the next 3 decades and beyond. And I'm really looking forward to having the opportunity to chat to you further over the coffee break. Thank you.